Good morning and welcome to Business Morning. I'm Chimeze Obi Iwago. Well, it's the decision day for the Monetary Policy Committee of the Central Bank, which started its two-day meeting on Tuesday. This is the first meeting of the committee for the year after a long wait for the approval of the newly appointed members by the National Assembly. Now, the Central Bank Governor Godwin Emefiele will be announcing the committee's decision by 2 p.m. and we will be joining the briefing live at that time. And we will also have a panel of discussants who will be right here in the studio to throw more light into what should be expected, and that will start by 1:30 this afternoon. In the meantime, let's look at the financial markets ahead of this decision. I'm being joined by an investment analyst at Afrinvest Securities, Omotola Abimbola. Good morning, Omotola.
Good morning.
Well, it seems everybody is waiting for this day. Well, being the first in the year, what are your expectations on the outcome of the meeting?
Well, for the MPC meeting that will be concluding today, we at Afrinvest, we are expecting the committee to maintain status quo on all policy rates. Albeit, we expect them to strongly communicate their desire to begin a policy easing cycle in the near term. And this expectation is anchored by the fact that the CBN has recorded tremendous progress in terms of its dual objective of price and exchange rate stability in the past 2 years. Looking at price stability, you would notice that in the past 1.5 years now, we have been seeing consistent deceleration in inflation starting from January 2017, and we are now down to about 14%, 14.3% from 18.7% that started in January 2017. Also, on exchange rate stability, we have been recording very stable exchange rates. The INE FX window rate has been stable at 36 naira to the dollar. Also, we are seeing very strong liquidity in the high and hill window. The external reserves, have gone up. Also, regarding the external accounts, current account surplus has been very strong. Trade balance has been in surplus as well. So in all ramifications, talking about external balance, speaking of FX market stability, speaking of consumer prices, we have seen very strong traction in all this. But despite all these factors I mentioned, you would notice that we are yet to record very substantial level of growth in the economy. Non-oil growth has been very weak, although we are seeing very strong numbers for the purchasing managers indices, both for the manufacturing and non-manufacturing indexes. But despite that, you will notice that non-oil sector growth has been very low. And even studying monetary aggregates, credit to the private sector has been very slow. Monetary aggregate data for February 2018 showed that we have recorded a mild 1.5% growth in private sector loans in the economy, where broad money supply has grown by just 0.2% in the 2 months. So there is a very strong argument for there to be policy easing in order to support non-oil sector growth, support lending to the private sector, and buoy money supply growth in the economy.
Yeah, so, but why would you now think that they should remain status quo? I mean, you at Afrinvest.
Correct. That's a very good question. And our reasons are that we think maintaining status quo is the more pragmatic option on two accounts. Number one, the CBN governor has been communicating in the past 1 year that the major anchor for monetary policy in the near term is consumer prices. And right now, if you're looking at CPI growth year on year, headline inflation is still above the monetary policy rates. Although you would notice that, although typically for monetary policy, inflation expectation matters much more than current inflation, and the CBN has succeeded in anchoring inflation expectation lower, such that by consensus, the market is expecting probably a single-digit inflation number before the end of the year. But despite this, we also know that this is the first MPC meeting of the year, where committee members typically like to maintain stability. And indeed, we'll be having 5 new committee members who will be joining the meeting for the first time. So we don't think they'll be looking to shake the table anytime soon. However, we think that a policy rate cut is a matter of when, not if. It's going to happen this year, but maybe not at this current MPC meeting.
All right. Now, the fixed income market seem to have been bullish since the start of the year. Would you now expect that to continue? Would you expect that to continue if the CBN perhaps decides to remain status quo?
We think it would continue. If you look at the fixed income markets, compared to averages in the bond markets of 16.5% in January 2017, we have seen a consistent decline in fixed income yields, particularly in the bond market, and also the T-bills markets. Currently, averages in the bond market is around 13.5%, nearly 350 basis points drop from where it was in 2017 January. Also in the treasury bills markets, we have seen a strong decline in T-bills yield and also HOMO clearing rates, although this is being driven by different factors other than monetary policy alone. There's the aspect of fiscal policy. Earlier last year, the federal government decided to alter its debt strategy to borrow more from the foreign market to reduce debt servicing costs. So that has led to a decline in primary market issuance and led to aggressive positioning in the fixed income markets by portfolio managers looking to avert reinvestment risk for their fixed income portfolio. Also, the CBN has, despite not cutting benchmark interest rates, they have succeeded in guiding market expectation for monetary policy towards a bias for easing. And that's why you will see that the clearing rates at the HOMO auctions being held by the CBN the last 1 year, they have been cutting back on the HOMO clearing rates. And we are seeing the impacts in the primary markets for T-bills and even the secondary markets as well, such that 12-month T-bills rate, which used to be at around 18.5%, is now down to about 14.2, 14.3%, nearly 13%, in fact, 13.2, 13.3%, nearly a 500 basis point drop from where it was a year ago. And despite the fact that we expect the CBN to maintain status quo at this policy meeting, we still think there is still ample room for there to be further decline in fixed income yields in the near term because of the strong disinflation we are seeing in the economy. Initially, the market was expecting probably inflation pressures to start building around February and March due to the seasonality factor, because when we enter the planting season, we usually see a food price spike. And that was what led to the aggressive month-on-month food inflation we saw in 2017. But if you study the consumer price index data for February 2018, you will see that we are seeing very subtle food price pressure, partly because we had a very strong harvest season in 2017. FAO data for grain production in Nigeria showed that we had a surge in grains producers in the economy in 2017 from where we were in 2016. So if you take this into consideration, that we're going to continue seeing further subtle food price movements, while the core index also remains stable, broadly driven by the stable FX rate environment, then with the consistent acceleration in inflation and also the possibility of a policy rate cut in the near term, there should still be ample room for there to be a further rally in the fixed income market before year end. But there's still downside risks to this because by the time we enter the second half of the year, we're going to enter the political season. Primary elections are due for October, and typically for most frontier countries such as Nigeria, we usually see some portfolio flows reversal during the peak of politicking, particularly ahead of elections. So that may probably lead to some FPR outflows. But based on the level of external reserves that we have right now, we think the CBN will aggressively defend the currency. And we also have enough domestic participants in the fixed income market to even ensure that the demand for fixed income instruments remains strong, despite the FPI flow reversals we expect to see in the second half of the year.
Okay, now let's look at the equity market. Well, while the fixed income seem to be bullish, the equity market, in contrast, has been underperforming in the recent week. Now, so how do you see this market reacting to the MPC decision and perhaps a forward guidance on policy rates?
For the equity market, in the recent weeks, performance has been very lackluster. We've been seeing aggressive profit taking in the markets on the earlier rate that we saw in January. Also seeing subtle decline in portfolio flows as well, as reviewed by recent NSC data on portfolio flow dynamics in the markets in recent months. And the reason for this is, I think, is cut in two ways. First, we have seen some very strong earnings missed by companies in the most recent earnings season.
But that didn't move the investors.
Yeah, it didn't move. We saw some very positive earnings surprises as well, but investors hardly reacted to it. Partly because for the first time in 3 years, we're now seeing dividend yield reported by companies in single digits. Last year, because of the level of valuation, valuations were very cheap last year because of the macroeconomic, the weak macro fundamentals and very weak portfolio flows. So between 2014 and 2016, we are seeing very high dividend yield that typically led to very strong performance in the equity market during earnings season. But this time around in the earnings season, we have some very strong earnings performance, but dividend yields are falling to single digits. And investors are just getting accustomed to this. So that led to some very, to some skepticism in the market. And there's also there's also an aspect of the prospects for forward earnings. Last year, most of the earnings results were driven by increase in prices by manufacturing companies and also the aggressive positioning in the fixed income markets by banks as well. But this time around, with inflation pressures almost subduing, we do not expect the same level of price increases by companies to compensate for margin decline as we saw in 2017. So all this skepticism on forward earnings is also filtering into the current valuation of the market. But regardless of what the MPC decides, we think that the weak sentiment will probably continue in the very near term, but we remain very confident of medium-term performance for the equity market because we have a very strong, because number one, with the decline in fixed income yields we are seeing, the cost of equity, which we use in valuing equity securities, is also declining. So the opportunity cost for investing in the equity markets is declining as well. So that should probably lead to some strong portfolio rebalancing and tilting towards the equity markets in the medium term for companies, for portfolio managers rather.
Okay. Now, there have been some concerns in some quarters as to the potential impact of easy monetary policy on banks' earnings. Do you share the same sentiment?
The concerns are not misplaced because if you look at the major drivers of performance for banks last year, you will see that interest income was a major component. Because of the tight monetary policy by the CBN in the last 2 years, banks' interest incomes have, they have surged because they have invested heavily in government securities and also the Omo bills as well. But this time around, since the beginning of the year, we've been seeing, further decline rather, in fixed income yields, so which is probably filtering into market expectation of forward earnings for banks. But despite that, I think for us at Afrinvest, we think that the impact might not be as much as the market is anticipating because banks could easily compensate for the decline in government securities with further credit extension in order to support their interest income. And if you look at the prospects for the economy in the near term, because we are now seeing much more better growth ahead, banks could take advantage of that to extend more loans to the real sector to compensate for that decline in government securities. So it's a major concern, right, for the market, but we think that the banks have their balance sheet structure is still very resilient enough to withstand the shock that will come from decline in government securities. In addition to that, declining fixed income use also would increase the mark-to-market position or gains on their trading assets as well, which they have in very heavy portion. In addition to that, because of the improving macroeconomic fundamentals, the level of impairments being taken by banks on their loan portfolio will also reduce. So even though we might not see aggressive or double-digit growth in gross earnings, because of the fact that their impairment charges are declining, the impact on their net margin might not be so much as market is anticipating.
All right. Thank you very much, Omotola, for your time. Omotola Abimbola is an analyst with the Afrinvest Securities. Well, we'll take a quick break, and when we return, we will continue with our preview of the MPC decision. Just stay with us.